That was Tiff Macklem and Deputy Governor Carolyn Rogers answering questions from the press on their decision to increase interest rates but pause at these levels. And we're joined by Warren Lovelace, Chief Rate Strategist at National Bank, who is also listening to the conference. And I had to restrain myself from almost leaping out of the chair because the number one question that eventually our own Kamutha Ramanathan asked was, what is the threshold for rate cuts? And he said it's far too early to be talking about cuts. Do you think that's going to change the market pricing in a rate cut for later this year?
Well, look, I think that was a key question, so I was glad that it was asked. And, not surprisingly, the governor, I think, tried to dance around that. I mean, you don't want to be raising interest rates one day and then trying to indicate that, very shortly you're going to be moving to lower interest rates. The reality is, for a lot of investors, though, a lot of market participants, they're investing not just with respect to where we are today, but where things are going to be in the future. So it's entirely appropriate for investors to be thinking about where interest rates will be at the end of the year. And I think rate cuts are on the table. And
I want to underline that he didn't say that that is not the right thing to be pricing in. And I contrast that with ECB head Christine Lagarde, who has said overtly, if you price that in, you're wrong. You're wrong about that. He says it's too early to be talking about cuts, but the market prices, into the future. Was that dovish as well?
Well, look, the way I think about this, we all learned about the 3 R's, right? Reduce, reuse, recycle. Now it's about rapid, restrictive, and resilience, right? So they have moved very rapidly into restrictive territory. They've moved more forcefully into more restrictive territory than many thought because of the resilience in the economy. So really now it becomes, how long do we maintain that resilience? If we start to see the labor market, the broader economy starting to not necessarily buckle, but give them even more confidence that an inflation victory is at hand, then it will be appropriate to move interest rates into less restrictive territory.
He sidestepped a specific part of Kamutha's question, is what are the parameters around a recession? Because there is a school of thought that they're not going to react, central banks are not going to react the way they have in past to recession because inflation is still a boogeyman. So we're not going to go back to the old playbook. Of course, we'd like to hear from a central banker, what playbook are they using? What is the threshold for rate cuts? Do you have an idea of what that might be?
Yeah, I have a sense on this, but just on this idea of a playbook, I like that language. The reality is, and the difficulty that we're facing is that, look, we don't really have a lot of interest rate tightening cycles to study, and we certainly don't have anything that even remotely resembles what we've gone through here in terms of the magnitude and speed. So it's really difficult to try to handicap where we're going because we've never done what we have done in the last 12 months. But in terms of getting to rate cuts, look, I want to be clear, easing interest rates, lowering interest rates from a very restrictive level isn't saying that you want to add stimulus to the economy. It would be a signal that, okay, we have confidence that inflation is getting back into a more comfortable zone. We don't need to be pushing the brake pedal as heavily, as hard. And I think, again, what we need to see is, of course, more progress on inflation, and I think critically a little less tightness in labor markets that the senior deputy governor picked up on.
The chart we're showing showed market expectations of rates before the decision, and actually shows that rate cuts are priced in for the rest of the year. I'll get off of this now, though, because there's another part, and it's their view for growth and their view for inflation. And he was very definitive on two things, that rate hikes are working and that they are, and I quote, "We are turning the corner on inflation." Is that a premature victory lap?
Yeah, I was almost sort of expecting, the mission accomplished banner to be unfurled, behind the governor and the senior deputy governor there. Certainly, I think what struck me there was the confidence that he was trying to project and governing council is trying to project in terms of turning the corner on inflation. It's working. We'll get there. We're resolute. We'll stay, we're on it. And I think, to be honest, we have confidence that we have really turned the corner on inflation. The other thing that struck me is that this is a conditional pause. It's a conditional commitment, if you will. And it's, if we end up seeing even quicker inflation relief, if growth is slower and lower, those are the two words I would focus on. Slower growth, lower inflation, then I think it will be appropriate to think about interest rate cuts before the year is out.
I mean, the monetary policy projections basically suggest a straight line down to 3% and then 2%. What if there's volatility? What if we get a month where it's higher?
Well, I mean, we've been living with volatility for a while, and including in some of our key data that we're trying to utilize to make these decisions, whether it's inflation data, critically, the labor market data are all over the map.
Don't even get me started, yeah.
So we really are living with that, plus financial market volatility, geopolitical uncertainty and volatility. So, look, I sympathize with policymakers here. There's a lot to juggle. There's a lot of indicators that they can look at. Some of them are more stable, predictable. Some of them are jumping all over the place. I think the overarching message here, though, is that we are seeing progress on inflation. The bank might even be surprised by how quickly inflation comes down. So, too early to talk about rate cuts, I guess, but by perhaps the autumn, the end of this year, if we're in a more becalmed environment on inflation, we see maybe a little less growth than what they expected, I think it'll be appropriate to be
Does this also signal a confidence by the Bank of Canada that they can't afford to be out of step with major central banks, namely the Fed, but also the ECB? Does their confidence and their definitiveness on the pause right now suggest that's what we're going to get from the Federal Reserve?
Yeah, so the Bank of Canada as the canary in the coal mine or leading indicator, there may be something to that. I think, to be fair, probably sitting here today, the Bank of Canada probably has a little bit more confidence that the Fed is getting closer to being done as well. We know there's another hike coming on February 1st. We might even get another hike from the Fed in March. But again, I think we can see it's getting clearer that the Fed is close, and that probably, again, gives them a little bit more confidence that policy won't be so misaligned with what is happening south of the border, because that's a pretty key comparison.
Canada has been, we rarely affect global markets, but I see global markets talking about this decision and previous ones because, A, we surprise a lot more often relative to consensus, and B, we move a lot earlier, whether it's to the upside or the downside on rates.
Yeah, and I think to some extent that's reflecting that, our economy is a little bit higher vol, right?
Yeah.
So I think it is appropriate that we need to be maybe moving and fine-tuning our policy a little bit more than some other large, more stable economies. And I think the other area where we've led, to be clear, and this didn't get a lot of attention in the press conference or really in the statement, is on the balance sheet, on quantitative tightening.
Yeah.
Let's not lose sight of the fact that the Bank of Canada has clearly been ahead of the Fed on that front as well.